Good morning, everyone. Good morning, Anthony. Good morning, Chris. So this is Maggie from FCL. We're the investor relation firms based in Sydney, but I personally work in Hong Kong for 15 years. I know Anthony for many times, many years as well. Chris have been in Hong Kong for many years as well. But maybe I quickly introduce you both. Anthony, the founder of Neo Capital, brings nearly 30 years of experience across high growth sectors, including natural resources, especially chemicals, and the EV, the lithium battery value chain. He held senior management roles in mining companies and now leads his own investment platform focused on strategic growth opportunities. For Christopher Han, Managing Director at Morgan Stanley, leads Asia Pacific General Industries and co-heads global energy transition with nearly 2 decades at the firm. He has been instrumental in shaping financial strategies across clean tech, industrials, and infrastructure, including recent energy transition transactions that reflect shifting investor priorities. So prior to this fireside chat, we also talk about the energy transition trend across the globe and how it shapes the investor perception. So especially I know you guys definitely know that the Hong Kong market is really hot this year, especially in the resources mining sector. So it continue to be the super connector, including a lot of landmark IPO, the CATL, the recent Zijin mining spin-off as well. So there are a lot of happening here actually in Hong Kong. So the first question I want to ask Chris first. So what do these landmark transactions tell us about Hong Kong roles in energy transition financing, and what can early growth mining companies, where we have a lot here today, that listed outside Hong Kong or China, can learn from seeking capital or partner here?
Okay, thank you very much, and thank you to the organizers for inviting me to speak with you today. What I'd say is that the focus on transition has evolved, right? But it was really the late 2000 teens heading into COVID, the 2020 to 22 hype cycle around going green at all costs. And then, of course, there was a crash, right? And we saw that in the resources, electrification metals. Obviously, a lot of the resources around electrification, like lithium, copper, nickel, what have you, they were seen as big beneficiaries because of this tremendous shift towards electrified transport, towards renewable energy, batteries, of course, at the center of that, to provide that firm dispatchable power with a decarbonized grid. And then what you've seen, of course, is now you have Trump, and you have lots of different headwinds around affordability, accessibility, and of course AI. Everything around AI. AI has really sucked a lot of that risk capital excitement away from transition to all the different things that we're seeing. And of course that market in Hong Kong, the Hong Kong capital markets were the ones that were performing. We're steady, stable companies, but overall, Hong Kong was dealing with the issues around growth, the issues around coming out of COVID, and of course the geopolitics. Now, all of that changed January 20th, right? When DeepSeek, a hedge fund no one's heard about, launched the R1 model, spending allegedly less than $6 million to come out with a model with a similar output and performance as ChatGPT 4.0, which OpenAI spent over $100 million on. So this was something that, got investors very curious, because I think up until then, many global investors were underweight China equity. They felt with the geopolitics, China for China, global for global, they're not going to overlap. We don't need to be invested. And soon after, you saw a lot of interest in innovation that's happening in China. China's not just about, scaling, costs down, local government support, taking other people's innovations and improving upon them. There's a recognition that actually we need to dig more. There's actually some real innovation that's happening. And of course, some of the early companies that tapped the capital markets were examples of that, ones that investors identified as really leading in innovation. So, BYD is one of the companies that raised $5.6 billion in a follow-on. They also announced right around that time God's Eye, their version of full self-driving, but instead of charging a premium to to their customers as a subscription service, really looking to roll this out for free. Base case, right? You had Xiaomi raise another, $5.5 billion, just rolling out a new EV product. Literally, 2 years after starting that program, rolling out a very innovative EV product that competes with the Model S, that competes with the Model Y, that had record sales in a very crowded market. And then, of course, you saw CATL, which was the leading player in batteries with 37 to 40% of the global share of batteries for EV, batteries for ESS. They raised $5.3 billion, right? And so this really, suddenly Hong Kong was back. I think one of the things that was conducive was the fact that these weren't really IPOs, they were follow-ons benchmarked to existing public equity, whether it's traded in the A-share market in CATL's case and BYD's case, or in the Hong Kong market in the other, in Xiaomi and the other, Xiaomi's case. And the Hong Kong and China equities were generally seen as cheap. So these companies were market leading, but trading at a discount, right? If you think about BYD versus Apple, Xiaomi versus Apple, BYD versus Tesla, CATL versus, say, an LG Energy Solution, there were big discounts. And so these deals worked. Investors made a lot of money. The regulator in China also saw the need to kind of open the spigot, open the tap to allow companies to raise capital. The domestic A-share market is still quite challenged. And one of the big things that's happened with Trump and the geopolitics is made in China serving the world may not be the long-term viable solution in a decoupled environment. So what, the big trend, of course, is China plus one, for all the Chinese players to bring their capacity, their capability offshore or nearer shore to the markets they want to serve. And as a result, they need US dollar proceeds, right? There's capital controls to take restricted cash onshore, offshore. So the Hong Kong market plays this unique role, right? It's a capital market for China companies that's politically acceptable, not like the US market was, or the US market now is more challenging for Chinese companies to raise capital. And at the same time, it's tapping global capital, right? Where the use of proceeds in BYD and CATL's case is to expand their supply chain overseas.
So we also see that there are surge, for outbound investment from China into like mining strategic resources in the past year. It's like the deal exceeding over $100 million in the past year. So there are a lot of happening, especially like in copper, lithium, especially for the EV transition, etc. So maybe this question for Anthony. So how do you see the Asian funds actually approaching the overseas investment?
Well, Chinese companies have always been very active in overseas resource investments for the past, I would say, 4 or 5 year plans. Has a very long-term strategic focus on resources and therefore started very early. Over the past 5-10 years, in many conversations, whether it's in Europe or North America, I get often asked the question, how come China has such a hold on resources around so many different parts of the world? Whether it's commercial offtakes coming out of Australia with certain levels of strategic investments. They're obviously very big in Chile and Argentina, and more recently in Africa as well. And the simple answer is that they just started early. They started very early. In my previous corporate life, I was a former MD and CEO of a company called Galaxy Resources, which became Allkem, which today actually half of the lithium assets that sit within the Rio Tinto portfolio were my former projects. So, that was a junior mining development company that I joined in 2010, and we became the world's 5th largest lithium producer. We actually, at that point in time, did attempt to do a Chapter 18 listing in Hong Kong back in 2010, 2011, actually had Morgan Stanley and also BNP as our co-managers on that. That was a very different point in time. The lithium market today is probably about coming up 1.5 million tons. It was only about 120, 130,000 tons back then. You really only had a couple of names that people knew about, Tesla and BYD, but EV sales globally was only probably in the thousands, tens of thousands. And it was only until 2015 that you had this big push in China on the policy and the subsidies and the rebate side, which drove EV sales. That's the first year where it broke 6 digits. I think it was 379,000, and then it went to 500,000, then it went to 800,000. And then obviously you see EVs where they are in China today. But it's been a long path. It's taken 15 years to kind of get here. I think, what's often forgotten is that there is a lot of long-term, resources are deemed to be of value, specifically in the Asian context and definitely in the Chinese cultural context. Whereas mining and natural resources very often, and some of my colleagues here from Canada and other parts of the world as well would know this, especially in Europe, there's very often the NIMBY attitude, which is anywhere but not in my backyard. Whereas the emphasis on natural resources in China is very much critical to each part of the value chain. And within kind of what Chris was talking about, the energy transition value chain, it's actually a fairly complex one. It's probably 4 steps to get from metal units out of the ground to metal units inside a battery that sits in a car or energy storage system. And China spent the past 15, 20 years actually building that up. So I would say that the outbound investments really started very much so on the upstream side and certain manufacturing hubs around Southeast Asia. On the energy transition side, what's become evident in the past 5-10 years is that they really do have a leadership position in many parts of the value chain. I mean, in terms of lithium, people talk about, oh, China has a control of lithium. They don't really have a control of lithium because still probably 60-70% of all the lithium chemicals they produce actually has to come from raw materials that gets imported into China. They have a very big hold on the processing capacity, and that goes the same for nickel, for cobalt, for graphite, which gets produced into anodes, a lot of synthetic graphite capacity there. And then obviously on other components that end up going into a battery, electrolyte, copper foil, separator, and then obviously cell manufacturing is very big as well as recycling is the biggest capacity. So, but they really started outbound investments on other parts of the value chain, I would probably say 5-6 years ago. It's only been very recent. But as an outbound investment strategy, it's always been there for natural resources, whether it's copper, oil and gas, or kind of iron ore. If you go down to Australia today, whether it's iron ore or whether it's lithium, there's probably hardly any one project that's not touched Chinese capital, whether it's strategic or commercial offtake. So that relationship has always been there. What you're seeing now is an extension of the China outbound going into other capabilities that China has had on the technology and processing side. And part and parcel of that is, as Chris pointed out, there are a lot of capital controls in China. And a lot of these companies were told by Beijing, says stop raising capital on the Shanghai and Shenzhen Stock Exchange and diluting everything in renminbi terms, only to export that liquidity overseas to invest and convert into US dollars. So there have been attempts, I would say, probably starting 4 or 5 years ago, of companies going abroad to raise capital. Now, ironically, notwithstanding you had a lot of manufacturing that kind of that has raised successful A-share equity raises in Hong Kong. From the energy transition perspective, ironically, a lot of them started overseas. I mean, some of you may be familiar with the GDR equity issuance that got launched as an initiative, I think about 4 or 5 years ago in Switzerland. You could say there was some moderate success, but the amount of capital that was raised was de minimis. It was like $1.5 billion among half a dozen Chinese companies. And there really wasn't the depth of market and liquidity and following on some of those Chinese names. And they were big Chinese names. You had Gotion, you had Guoxuan, you had Huayou Guye, you had Huayou Cobalt, and you had a few other kind of tier 1.5 players that raised capital in Europe. But the reality is that actually didn't really bring on that much by way of international institutional investors. Very often it was Chinese hedge funds that actually had overseas investment quotas who would be subscribing to that. So it really didn't introduce kind of new investors into the capital structure and facilitate that. I think as geopolitics is starting to get more tense over the past few years, there's been a pivot back to Hong Kong. And then obviously you've seen a redomiciling of a lot of NASDAQ and NYSE listed Chinese companies coming to Hong Kong as well. But more interestingly, obviously within my world, I mean, I'm, apart from this particular hat that I'm wearing today, I'm also a chairman of another lithium development company as well as a cathode materials company, both listed overseas. But what you've seen now is that there's a clear need to build capacity outside of Asia, whether for geopolitical reasons or for environmental footprint reasons or for transport, reducing costs to be closer to the market. But as we know, also it's quite challenging to raise capital because invariably many other parts of the world typically would have a higher operating cost or a higher capital intensity to build these projects compared with China, right? So that comparison could be if it costs $1 for you to build a certain capacity in China, Southeast Asia, Indonesia, you can probably get away with 1.2 to 1.5. Morocco, where you're seeing a lot of Chinese investment at the moment, is probably 2.5. Central Eastern Europe is probably 2 to 3. But then once you start stepping into Western Europe and North America, all of a sudden it starts to get quite expensive. Now, obviously, there's policy funding and subsidies that look to abate that. So the amount of capital that you need to raise now for some of these Chinese companies looking to build overseas is significantly more. And so what you've seen in the trend is, outside of the automakers that were already kind of listed in Hong Kong, and Chris talked about the battery makers, but even in the midstream, you've seen precursor companies, you've seen chemical companies such as the likes of Ganfeng and Tianqi. Ganfeng was probably the first Chinese lithium company to come an IPO in Hong Kong. Tianqi followed closely behind. Ganfeng had another successful secondary offering, a follow-on offering recently to raise $325 million here. And they are continuing their overseas expansion as well. So originally, Ganfeng was very, very focused on China production capacity. And they would do select kind of investments in the upstream and resources. But now they're investing in chemical processing capacity in Argentina, in Africa, in other parts of the world. And you have other companies doing the same as well. For example, in Indonesia, Indonesia has probably been the first stop of new kind of hard rock lithium conversion capacity that's been built out. So, I would say that is not a new trend. It's just a trend that's now extended into other parts of the value chain. And there's been experiments in other capital markets. And I think there's a realization from many companies that, Hong Kong is just as good, if anything, there's a lot more depth of liquidity for them to tap into here.
So, both gentlemen, you mentioned about geopolitics, which definitely is one of the, factor. And we can also see a lot of Chinese investors or companies. You said it's not a new trend, but definitely they're also expanding or looking for opportunities in the overseas market. So we have a lot of early growth companies here with us today. Any when Asian investor really doing the expansion, any jurisdictions, ESG, what kind of factors that they actually focus more when they really determine and investment targets? So both gentlemen.
Yeah, maybe I'll start. I mean, I think there's definitely a bifurcation of the markets. So the U.S. is typically seen as the most profitable, deepest market for clean tech. So it's not the biggest in terms of volume, but in terms of margin, it's very attractive. So if you look at solar, for example, the margins on solar products are much higher than what you see elsewhere. And the U.S. does put very tight, stringent policies in place, like the Forced Labor Prevention Act, the Section 201, 301, all these import duties, what have you. So actually what you find is there is differential pricing in terms of materials serving the world and materials serving US. So polysilicon, which is the raw material or the process material that goes into wafer cells and modules, is like $20 a kg serving the US. It's $6 to $8 a kg serving the rest of the world. So this is something we try to understand, are we going to see this replicated in other battery materials, right? Because of course, with the One Big Beautiful Bill and what President Trump has passed into law, there's a big focus on decoupling from the China supply chain. So everything made in China or even made by China outside of China with ownership at a certain level is so-called FIAC, or prohibitive foreign entity, foreign controlled entity, foreign influenced entity, specified foreign entity, all these definitions to try to preclude companies that use that material in their systems and their solutions downstream from getting any eligibility for subsidies, right? And the what was the IRA is still providing attractive subsidies for certain segments in things like batteries, right? For batteries for energy storage. So this topic around material assistance is something that is causing a lot of confusion in the U.S. market, and a lot of companies and consumers and investors are looking ideally for the U.S. to have so-called non-FIAC supply chains all the way through. So I think it depends, right? If you're a Chinese player that is looking to serve that U.S. market, okay, you need to go first outside of China. You need to potentially dilute ownership to a certain level below which or above which you're not going to be able to serve that market, or your customers won't want that product because of the subsidy ineligibility. You're going to have to do partnerships with Western-oriented companies, Western capital providers, strategics, and that's one strategy, which I think the Chinese recognize. If they're going to serve the U.S., they're going to have to kind of reshape how they do that and what partnerships and joint ventures they enter into. If they want to serve the rest of the world, not a problem. Right now, you can just go to Europe, nearshore your capacity in Europe, whether it's intermediate chemicals, it's the downstream cell manufacturing. As long as you're nearshore, you're supplying to the market, you've addressed that security issue, at least for now, right? The question long term is the protectionist measures you see with America First and MAGA. Does that spread beyond the U.S. to other markets like Europe, like Australia, what have you? And we'll see. And so if you're a Western-oriented battery materials player or mining resources player, of course, you can think about how do you serve that profitable U.S. market that cares about traceability. And maybe what we see in solar, maybe there will be different pricing for different supply chains serving that market versus the non-U.S. market. We'll see, right? So I think it's different strategies. And I think the one thing is, if you look at the U.S., as I said, I'm from a volume standpoint, and since we've been talking a lot about batteries, I mean, U.S. only represents about 10% of the global EV market, but about 20% of the market for ESS. And of course, right now, the big thematic and why transition is now participating in the equity market is because it's related to AI, right? You need power, energy, resources for AI, and you need also batteries. I mean, all the big investors and hyperscalers that invest in these data centers, a lot of that's in the US, they have not given up their net zero targets. So they are very focused on scope 1, 2, and 3 emissions. They want more renewable energy. You need batteries to solve that. And and of course, we need AI for energy too, right? So it's interrelated. Pause there.
I think just to follow on from Chris, but also to provide probably a slightly alternate way of looking at the opportunities here is, I mean, just to follow up on Chris's point about AI, it is very much a global phenomena. Just to provide some data to back that up. If you look at 2024 over 2023, EVs grew at probably about 25% year on year globally. Energy storage system demand grew at 53%. If you look at where we are today on a global basis, EVs is probably up from something similar, 25-30%. First half of this year, global ESS production output is up 106%. The US is actually declining in terms of share. So, Chris is right in terms of EVs from a US perspective the US is becoming very much a laggard. Obviously, it's led by China. You have a lot of growth in Southeast Asia. Literally just got off the plane back from Melbourne today. You have a lot of Chinese and EVs kind of being sold in Australia and South America, Central South America. So EVs in everywhere but the US is actually growing quite healthily. But importantly, this year, especially the Middle East and Australia, has also proven to be very, very strong growth markets for ESS. So if we're talking about energy transition and battery-related or energy-related materials or resources, my counter view or my alternate view is that there is actually still a very, very big market outside of the US. And so it depends on which part of the value chain kind of that you're focusing on. The other thing which I think is actually kind of quite interesting, especially on the resources side, invariably for those junior development, and I've been a junior development company kind of CEO myself, and invariably you will have a lot of business dealings with companies in and around Asia, including China and Japan and Korea, because that's where most of the processing gets done, and therefore most of the customer conversations that you're going to be having potentially will be in this part of the world. The reality is that whether it's the battery value chain or other parts of the value chain, there is still very limited processing capacity in other parts of the world because it's just been so underinvested for the past several decades, right? And primarily that was because, they didn't want to have heavy, maybe slightly more environmentally intensive operations in their backyard, and Asia was more prepared to do so. The interesting thing that I find today compared to, let's say, 15 years ago when we tried to do a Chapter 18 listing in Hong Kong was, other than the market being very small, is the know-how and IP and the familiarity of investors in Hong Kong within what was then, for me, the battery space, but also natural resources space, was very, very limited. Because other than gold and precious and maybe some iron ore, and some heavy industrial power generation companies from China, there's very, very limited know-how in kind of these new growth markets. Fast forward 15 years, you have automakers listed here, you have EV automakers listed here, you have battery makers listed here, you have recycling companies listed here, you have precursor, you have chemical companies listed, as well as kind of other mining companies. So, I would actively encourage, because when that level of IP steps up, I mean, it's actually quite funny to think about it, but back then, I had to go back to the ABCs of what's a battery? How does the lithium get from in the ground into a battery? And why should I believe that this is going to be a growth sector? Well, the last couple of those questions don't really need to be addressed today because the general level of education within the Hong Kong market is extraordinarily high compared to where it was. And it's been because there's been a proliferation of other companies that come listed in Hong Kong that have helped with that education process. So then as a natural resource company, if you're coming here, then you're really only just focusing on, you don't really need to explain the thematic anymore, right? Everyone gets it. Then it's all back down to your project. What's your permitting time frame? How much capital you need to raise? What's your cost? Who your customers, and when can you get into production and cash flow? And that makes life a lot easier from a Hong Kong perspective. And so I think Hong Kong is going through potentially an interesting kind of rejuvenation and refocus back on the natural resources side, which it has lagged in the past kind of few decades. I mean, Australia and Canada are still very much viewed, and to a certain extent London, still very much viewed as the kind of natural resource capital markets for the world. Even I would say New York is very, very limited in that respects. And so I do think that there's, especially for stuff and metal units that invariably either China or Chinese companies are looking to continue to procure over the coming decades. I think if you're in that particular sphere or pockets of the periodic table where it's in demand in Asia and other growth markets around the world as well, I think it's well worth kind of considering as a venue.
So definitely, I mean, the Hong Kong Chinese investor are more like familiar with the market, with the value chain. But the question is, which part of the value chain do you see is more attractive to especially in the energy transition, is more attractive to the Hong Kong Chinese or Asian investors? Do you see
the ones that make money? I mean,
Which one?
to be really honest, at the end of the day, it comes back down to fundamentals. It really comes back down to fundamentals. It's no different from when I'm down marketing in Australia, and and yes, they'll take momentum on junior development companies, but then at the end of the day, it's like, okay, what's your C1 cost? What's your head grade? What's your recovery? It all comes back down to fundamentals. And that's the most defensible position that you can have. Obviously, if you're in an interesting segment in the industry and it's got a very prospective and good potential growth kind of dynamic in it, that helps. But everything ultimately comes back down to fundamentals. Like, Chapter 18 at the time was with the view of allowing NI 43-101 compliant or JORC resource compliant companies to come and list. And there's a certain amount of risk that the Hong Kong market can take, but your cash flows can't be 3 to 5 years away. So for junior development companies, that's kind of when you need to kind of really try and pick the timing, to the extent that you are starting to build an investor base in Asia, in and around Hong Kong. You're doing business with either China, Korea, and Japan. You're in the right thematic. It's that point in time when I think if you're kind of within that sphere of you could be plus or minus 2 years from cash flow, then I think Hong Kong investors are much more kind of prepared to give you that. And don't forget, there's a lot more capital being managed here, which is actually on behalf of Chinese LPs, and they have a different outlook in terms of risk profile and resources and how they can get into cash flows. But fundamentally, the core there's been a lot of, I wouldn't say redemption, there's been a lot of capital that's foreign LP capital that's probably no longer managed in Hong Kong as well. So the mix of the traditional, we just wanted to make money, and unless you've got like a single digit PE, then we're not going to pay attention to you. I think that's changed because you've gotten more, I would say, not influence, but there's just more integration with also how Chinese institutional as well as corporate investors kind of see the world and how they're looking to leverage on the Hong Kong capital markets as well.
So for Chris, apart from IPO, we also see a lot of M&A in the past few years, especially in the energy transitions spectrum. So did you see any trend shift, for example, from like board-based acquisition to really strategic focused deals, or any trend that you can share with us that you can see?
Yeah, I think Anthony touched on this. For the last 2-3 decades, there has always been an outbound, but a lot of times that was led by the SOEs around resource capture, oil and gas resources, and markets that are welcoming this Chinese capital to come in and do the quid pro quo. So, of course, what we call Belt and Road, or those types of markets. Of course, in 2005 to 2015, there was really the peak of just broader China outbound, including like those trophy assets in North America and Western Europe. The geopolitics are such that I think that has certainly slowed, right? And so I think outbound M&A is right now still, China outbound M&A is still not a, it's a big trend, but of course, it's more measured, right? Because I think Chinese companies, even the Chinese government, doesn't want that capital, especially state-linked capital, to go in markets where they're not welcome, right? And I think there are certain jurisdictions, even in this part of the region, where there's foreign investment review processes, which are now putting much more stringent measures on capital coming from China, or even coming from Hong Kong. Right, Hong Kong is now seen as part of China, and so even Hong Kong entrepreneur-owned businesses or companies that have been in the private sector their whole time, and they've been very big investors in infrastructure and other assets in, say, the UK or Australia. They're having challenges putting more incremental capital in. So I think that's one thing, but of course, the companies out of China know that they're no longer just serving China for China. They're serving the world. And a lot of them are global leaders, like some of the companies we mentioned. And they want to serve all global markets, including North America, which historically has been a very attractive, high-margin market. So the motivation is very much there to respond to the trend of this nearshoring, this partnering, this joint venture. So a lot of the outbound M&A and dialogues that we have with some of these companies in these supply chains is to really help them bring their capability outside of China in jurisdictions that are more politically neutral, that potentially could serve as a base to serve East and West, right? And serving West may require dilution of ownership, may require bringing, foreign partners, local partners, financial and strategic, and complying. But at the same time, look, I think there's a certain level where the geopolitics becomes so intense that it's lose-lose. And we're kind of seeing this whole thing around what the U.S. is doing with One Big Beautiful Bill and their import duties, and the threats that President Trump makes from time to time, and what China is doing in terms of their reactions, right, around, potential export controls. We've certainly seen an announcement recently in the whole battery materials value chain that could be quite impactful for, all these reshoring discussions, even onshoring discussions, even in the United States, right? Because there could be controls on not just the raw materials and the process materials, but also the tools and the equipment and the production line and the technologies. So we'll see how this shapes up. And I think while this geopolitics remains very uncertain, that is obviously causing some pause, right, for people to deploy massive amount of capital in outbound if they don't know the rules are going to be set today or they're going to change like within the next 1 or 2 years.
From a company's perspective, I don't feel that one needs to feel completely held hostage by the geopolitics. I'll give you a couple of examples. Ganfeng was a big investor in this company called Lithium Americas, developed a project in Argentina. That same company also has a very large project in Nevada, in the US, a project called Thacker Pass, which is now the US's largest lithium project under development. The company called Lithium Americas owned both the Argentine asset and the US asset. The US asset was looking to raise capital from the Department of Energy and also less influential, but also from GM as well, and did secure that. But the quid pro quo of what had to be done, and Ganfeng was a significant investor in Lithium Americas, because they essentially funded all of the Argentine project financing and development, and essentially owned all of the offtake. But essentially what Lithium Americas ended up doing was reorganizing a company where they split the asset so that the US company would be able to continue and raise capital from the US government. The Argentine company ended up re-domiciling, and Ganfeng was able to retain its holding, and continue to fund additional development into not only the Cauchari project but also subsequent acquisitions. They acquired another project called Millennium, and then they're now working on another project again called Mariana. So as a project owner, there are, if you think about it, ultimately, at least the way I felt as a CEO and as an MD, my obligation, I have a fiduciary obligation to my shareholders and investors to try and extract as much value as I can for them. And it's unfortunate sometimes to get kind of strung up into all the geopolitics, but there are other ways to structure around that. I've seen TSX listed companies, Canadian companies, with assets not necessarily in Canada, in other parts of the world. For example, in Africa, there's Jada's probably like there's some graphite companies that we know of who basically ended up re-domiciling out of Canada into other places such as the Middle East, and even considering kind of raising capital in Hong Kong. So, and we've seen deals continue to be done with Australian companies. For example, Peak Resources, a rare earth development in Africa, recently kind of got acquired by Shenghe. So I wouldn't say that, if 10 years ago the playbook was we try and develop, create value, sell into Asia, sell into China, and then maybe like the ultimate is an exit or an M&A by a Chinese company. I don't think that playbook is off the cards now. It just needs to be structured in such a way where you can still do the right job that you need to do for your shareholders to unlock that value. But just one has to be, for example, in Australia, you've got FIRB that you have to be aware of. But there are kind of many other ways that you can do things that structure transactions at an asset level, where you can still bring in the capital that you need, the risk capital that you need, because frankly speaking, a lot of the risk capital that's provided to the natural resources world has actually come from China, and they're the most prepared, as a category of investor, they're the most prepared to write you those checks. Right? You would not believe how hard it is to get development capital to develop natural resources in North America. They're prepared to give you a check once you're at FID and pre-construction and everything. But, that $50, $100, $200 million that you need to raise and spend in order to get to FID is very often hard to come by. And so I look at even within my own lithium world today, almost all of the lithium units that are coming out of Australia today basically has all had help along the way from Chinese capital. So, I think there are ways that you can maneuver and structure around kind of the geopolitics to kind of give you that optionality. And and so I don't think one needs to be beholden to geopolitics. You just have to be a little bit more proactive in terms of how to work around them.
So I'm mindful of the time, so this is one final question. We see a lot of like cross-border transactions in the past years, and I want to ask is in terms of investor appetite, what do you see the trend or changes in the past few years, and how Hong Kong still become relevant in terms of for the companies who wants to like raise capital or any deal structure change in terms of like M&A in the past year in the energy transition spectrum. What do you see the trend and how Hong Kong remain? What do you see that Hong Kong remains relevant to both investors and corporate who seek Asian capitals?
Well, so I'm going to use one case, which is it's all public. CATL raised $5.3 billion. At the same time, they had $40 billion on their balance sheet, and they had about less than $20 billion of debt. So their net cash was $20 billion, but they raised $5 billion primary in Hong Kong. The use of proceeds of that $5.3 billion was primarily to build out Hungary, their 100 gigawatt hour plant that they're building in Europe to provide a near shore solution for their customers in Europe. So why one would argue why would they raise primary if they had the net cash? And the capital controls are real, right? There are issues around getting that onshore cash offshore. So obviously there are other motivations around IPO. Getting global capital to come in because global capital is quite restricted to buy A shares. And CATL certainly sees itself as a global company. So I think the Hong Kong capital markets will serve a very key role for these Chinese companies that, post tariffs and a more decoupled world, they need to bring their capability outside of China. And the U.S. was that big capital market, right? I mean, China was importing capital from the U.S., exporting capital from outbound M&A. I think the U.S., again, with the geopolitics, it's no longer the primary go-to market to raise capital if you're a Chinese issuer.
I think for Hong Kong, the opportunities beyond kind of, if I think about the likes of CATL and BYD, they're all the way downstream in a particular value chain. And I think the opportunities are if you're a development company or you're a resource company that feeds into that particular thematic, then the midstream and upstream is where I think opportunities remain for Hong Kong investors as well. Because if you've already done the homework to actually understand the growth in AI, in energy transition, in energy storage, and EVs, you understand that this is no longer just a China-only trend. It is very much a global trend, and there are many other markets that will be growing as fast as China has in the past 10 years over the next 10 years. And much of that is going to be supplied, provided by, in terms of batteries and systems, by leading Chinese players. And guess what? Leading Chinese players will also need the metal units. They'll need the material units. And just like the past 20, 30, 40 years, most of those material metal units come from outside of China. So if you're a resource company that's feeding into that thematic, I would say that you're going to get at least, because the level of education has come up that much more in the past 10 years in Hong Kong. It's not as hard a sell as it was, at least for me, 15 years ago, in terms of educating the market. And the key is kind of hitting that right thematic, because I think there's a general appreciation in Hong Kong that if China policy is pointing in a certain direction, then you can't go far wrong if you're kind of heading in generally the same direction as it, right? So if, for example, many years, 5, 6 years ago, China decided to start clamping down into kind of online education, and maybe that's probably not a sector that you should be focusing on. But obviously, we're a resource kind of intensive kind of audience today. Resources will always be very strategic in Asia, not just for China, but increasingly for Korea and Japan as well. and there's an increasing appreciation of that in the Hong Kong market with investors that participate here.
So thank you so much, Chris and Anthony, today, sharing with us a lot of, especially in the energy transition, how the China capital is actually shaping the world and how actually the capital deploying across the globe as well. So thank you very much, Chris and Anthony. Thank you very much for your time as well.